America's trade policies have claimed another victim. According to Manufacturing and Technology News, America's machine tool industry is near the point of no return. It could become the latest casualty in the United States' terrible international trade dealings. The United States used to dominate this industry, but for several decades we've seen our market share drop into the abyss. In January of 2008, the market for American machine tools was worth $448 million. In January of 2009, however, it had shrunk to a paltry $95 million. The United States has the world's largest GDP, at approximately $14.2 trillion. But Germany, Japan, China, Taiwan, and several other nations are ahead of the U.S. in terms of their production of these basic industrial necessities. The fact that the U.S. is behind smaller economies in machine tool production is a product of the unfair trade policies that give America's competition a decided advantage. The U.S. is put at a major disadvantage against other countries who are allowed to manipulate their currencies and strategically protect their necessary industries. Long before the credit crunch pinched consumers and producers alike, the U.S. had witnessed the slow and steady flight of its production into more advantageous markets. When the credit crisis got into full swing here in the domestic market, people could no longer afford the work of American machine shops. They began bargain shopping for auto parts, and the prospect of buying a new vehicle was out of the question. Construction jobs contracted and eventually ground to a halt, dampening demand not only for American tools, but for the things made with American tools. Banks are unwilling to lend any money at all, preferring instead to hoard it for themselves before paying it out to their executives, instead of lending it to consumers who need it. Even companies as large and robust as Caterpillar are unable to get lines of credit from banks and other financiers. When large multinational conglomerates like Caterpillar are unable to find lenders, how are the rest supposed to survive? The lack of new orders is affecting the smallest companies the hardest. They are the ones who rely the most on lines of credit to keep them afloat. And when that credit dries up, they are left to fend for themselves against the subsidized competition they receive from overseas. The machine tool industry is no different than any other American manufacturing industry. It is shedding jobs rapidly to compete with low labor costs in China and other third world countries, only to be put out of business in the end by those same foreign competition. There are only a few people able to hang on at this point, and some of them have been helped because they are absolutely essential to certain national security parts of our economy, but in large part, the businesses have been taken over by foreign competition. The United States cannot expect to survive if it continues losing basic industrial industries. The machine tool sector may seem like an inconsequential part of the economy, but the fact that this makes up only a small portion is vital to our ability to save it from overseas dominance. If the U.S. cannot even support its own tool industry, how can we expect to save those industries which use those tools? We need a new path for development in the U.S., and it needs to start at the bottom and work its way to the top. Instead of hoping that the bank bailouts will trickle down to the real economy, we need to make sure that the real economy is built up. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other related topics, please log on to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!
Produced by economyincrisis.org.